Starting off. Our question practice here. We're looking into question 237, I guess. We finished the 236 yesterday. We started our questions. Yesterday, we finished quite a few questions of this chapter, starting at about 229. I think the last question is 236 that we have finished. Let's move on to the next set of questions and get done with this chapter today. Looking into question 237. They're saying Headington Co. is owed 37 by a customer. Okay, so it's corresponding it to the answer here. So Headington Co. is the name of the company. Okay, name of the company is Headington Co. Okay, this is the company Headington Co. Okay, so this is the company Headington Co. Okay, sells on credit. So basically they sell on credit. And at the start of the year, a customer owed them 37,500. So at the start of the year, a customer owed them 37,500 and 39,000 at the end. Okay, and at the end of the year, 39,000 he owed. So you see, 37,500, 39,000. We have arranged the two. Okay. At the end of the year, it is 39, and the start of the year, it is 37,500. Now, during the year, there was a cash sales of 263. Okay, so we first utilize these two numbers. 37,500 is gone, 39,000 is gone. Utilize this number, 37,500 and 39,000. Now utilize this 37,500 and 39,000. We have utilized these two numbers, 37,500 and 39,000. Next, what happened was during the year, cash sales of 263,500 and credit sales of 357,500 were made. Okay, cash and credit sales. So you know credit sales, we take it here. We have done a couple of sums yesterday. Credit sales always come here because they increase your receivables at the end of the days. And contrast with payables were 15,750. Again, contrast was also there with payables. Contra, we know that we from the same customer we are buying also, we are selling also. We do a net. So this reduces our receivables. Okay. Discount received is not relevant to us right now. Irrecoverable debts were 10,500. Okay, irrecoverable debts were 10,500. Okay, so now they're asking how much cash was received during the year. So you just take the balancing figure. Okay, you just take the balancing figure. A question that we had done yesterday only, similar questions. And just finding different things at different times.
So sorry to interrupt. Can you please repeat again? Your voice was lagging.
Okay. Can you hear me now, Bhavya? Abhi clear hai?
Yes, sir. Now it is clear.
Okay, done. So, firstly here, when we start the sum, that says Headington Co. is owed 37,500. Okay, what does Headington Co.? Headington Co. is owed 37,500. So you see the balance brought forward over here is 37,500. Okay, the balance brought forward here is 37,500. Okay. So is owed 37,500, balance brought down 37,500. So opening is there, opening is there. Closing is 39,000, closing is 39,000. Yeah, following this, Bhavya, opening, closing.
Yes, sir.
Now, okay, moving on. They said cash sales were 263,500, credit sales was 357. So see, credit sales we always utilize because it increases your receivables. What does credit sale do? It increases your receivables. What does credit sale do? It increases your receivables. So you see your credit sales is 357,500. Credit sales is 357,500. What is credit sales? 357,500. This is your credit sales. 357,500. This is your credit sales. Okay, I'm just arranging everything here. Next, they're telling that the contrast were 15,750. So this is our contrast, 15,750. Right? Contrast is basically when you buy and sell from the same person. So you don't pay them cash. You just keep deducting each other's amounts. So that's contrast 15,750. And discount received is not relevant to receivables, it's only relevant to purchases. Irrecoverable debts is 10,500. Okay, irrecoverable debts is 10,500. What is irrecoverable debts? 10,500. Okay, irrecoverable debts 10,500. Okay, irrecoverable debts is 10,500. What are irrecoverable debts? 10,500. Okay, and balance carried forward. The closing balance is 39,000. What is the balance carried forward? The closing balance is 39,000. What is the balance carried forward? The closing balance is 39,000. What is the closing balance? Closing balance is 39,000. Okay, balance carried forward. The closing balance is 39,000. Okay, the balance carried forward is 39,000. Okay, what is the balance carried forward? The balance carried forward is 39,000. Okay, the balance carried forward is 39,000. Okay, balance carried forward is 39,000. Okay, balance carried forward is 39,000. Okay, the brought forward 37,500, carried forward 39,000. Sales, credit sales 357, contra given to us 15,750, irrecoverable debts 10,500, and we just have to find how much cash was paid to us by the customers. So that is your balancing figure. That is your balancing figure, right? We had done this sum similar yesterday. If you look here, same sum, balance brought forward, sales, received contra, same sum, balance brought forward, credit sales, contra, irrecoverable debts, cash received from customer, balance carried forward. Here everything is given except this. Same sum once again yesterday, balance brought down, credit sales, cash received, contra, irrecoverable debts, balance. So cash received we have to find in this sum that we have just done. Same thing, balance brought forward, sales, cash, irrecoverable debts, carried, balance brought forward and carried forward, and then cash received. Cash received we have to find. So same sum we have done again and again since we started, and it is just the same sum. Just this time we have to find the cash that has been paid by the customers. That's it. They're just asking for a separate thing. It is the same sum. Okay. Did it make sense of this, Bhavya? Any questions on this one? Okay. Jaswanti, is it clear this one?
Yes, sir.
Okay. Ranbir, have you joined in, buddy? Okay. Vaibhavi, have you joined in? Okay. Sneha? Okay. Ranbir is here. Okay. So that is about this. Okay. That is about this. Okay. So 237, we have picked this up. We have got the brought forward. We have got the carried forward. We got the brought forward also. We got the carried forward also. Then we understood the contra, irrecoverable debts written off. Okay. And we all needed just the balancing figure. We just needed the balancing figure. All we needed was the balancing figure. Okay. Okay. This is about this. Moving on now. Next question, 238. The sales revenue. Let's understand what is happening over here. Okay. The sales revenue. Building this question here, the sales revenue of Jayco was 2 million. What was the sales revenue of Jayco? It was 2 million. What was the sales revenue of Jayco? It was 2 million. Okay. Sales revenue 2 million. And its receivables were 5% of sales. What were the receivables? Receivables were 5% of sales. Sales revenue was 2 million. This was the total revenue. Receivables were 5% of sales. So 5% of 2 million. Okay. 5% of 2 million. Okay. So this was the receivables. 100,000 was the receivables. Jayco wishes to have a specific allowance for receivables of 4,000. Right? He wishes to have a specific allowance for receivables 4,000. His allowance is 4,000. So allowance we use when we want to find net receivables. We should make the allowance one third of the current allowance. So what is the current allowance? If one third is 4,000, what is one? Right? The current allowance is the three-fourth of the current. So what is happening is Jayco wishes to have specific allowance for the one which would make the allowance one third higher than the current allowance. So whatever the current allowance is, it would make it higher, one third higher, right? So it would make one third higher. So you do 4,000 into 3 by 4 because one third from one when you remove one third from one when you remove 1 by 3, 1 minus 1 by 3. So you'll find out the old one, right? If the increased one is 4,000, what is the old one? So old one you have done 4,000 into 3 by 4. How did you get 3 by 4? If 1 by 3 is higher, you just want to find the remaining part of it. So you do 1 minus 1 by 3. So you will get 3 by 4. Okay. So it is how much? It is, make it one third higher than the current allowance. So you want to make it one third higher. So you take into 3 by 4. So when you take 3 by 4, you will get the answer as 3,000. So the old one was 3,000, new one is 4,000. So now they're asking is how will the profit be affected by the change in allowance? So how much has the allowance gone up by? Okay, you can see the increase in allowance is 1,000. You see the increase in allowance is 1,000, right? An increase in allowance reduces your profit. So your profit will be reduced by 1,000. Right? How much is your allowance increased? By 1,000. And allowance is an expense. So your profit will reduce by 1,000. Okay, once again. So there's a sale revenue of 2 million. How much is the sales revenue? 2 million. 5% of it is receivables. Okay, that much is credit sales. How much is credit sales? 1 lakh is credit sales. Of 2 million, 1 lakh is credit sales. Of 2 million, 1 lakh is credit sales. Okay. Of 2 million, 1 lakh is credit sales. Okay. Sales revenue is 2 million. Of that, 1 lakh is credit sales. Okay. Sales revenue is 2 million. Out of that, 5%, that is 1 lakh is your credit sales. Okay. Sales revenue is 2 million. Of that, 5%, 1 lakh is your credit sales. Okay. Of that, 5% of 2 million, 1 lakh is your credit sales. Okay. So sales revenue is 2 million. Out of that, 5%, 1 lakh is your credit sales. Okay. J wishes to have a specific allowance for receivables of 4,000. J wishes to have a specific allowance for receivables at 4,000. The required specific allowance for receivables is 4,000. Okay. Which is basically one third higher. Okay. It is one third higher. X plus X by 3. Right. X plus X by 3. One third higher. Okay. You're increasing the current allowance was X. You're increasing it by one third. X plus. Right. You're increasing it by one third. 1x plus X by 3 into, right, 1 by 3 into x. So first you will take x, current was x, plus one third higher, so 1 by 3 into x. Okay, x plus 1 by 3 into x if you do, you will get, and if you apply solve for x, you will get the 3,000. X plus 1 by 3 into x is equal to 4,000. So current allowance plus one third of the current allowance will give you 4,000. What is the current allowance? Okay, so you do x plus 1 by 3x is equal to 4,000. Now x is the old allowance plus one third higher. So plus and one third. So one third x, x by 3, x plus x by 3 is equal to 4,000. Now you solve for x, you will get 3,000. So that is the old allowance. So how much has your allowance increased? Increased by 1,000. How much has your allowance increased? An allowance, in when you increase the allowance, it's an expense because you're keeping more money in the side for someone who you think will not pay. You're keeping more money in the side. It's a reduction in profit. An allowance is a reduction in profit. So by 1,000, your profit will reduce. By 1,000, your profit will reduce. Okay, what will happen? By 1,000, your profit will reduce. Your profit will reduce by 1,000. Okay, what will happen is your profit will reduce by 1,000. Okay, your profit will reduce by 1,000. Okay, your profit will reduce by 1,000. Okay, what will happen is your profit will reduce by 1,000. Okay, so that is the logic here. Your profit will reduce by 1,000. Okay, so reduce your profit by 1,000. That's all it is here. Reduction in profit by 1,000. All right. So take us through your understanding here, Jaswanti. How have you understood this one? 238.
So out of 2 million sales,
Yes.
100,000 expenses.
Very good.
The goal allowance receivables 1 million,
Okay.
which is one third higher than the current one.
Very
You
good.
increase, if you increase the allowance by 1,000, which is an expense, so it would decrease the profit.
It will decrease your profit. Perfect. Okay. This is 238. Let's move on to the next one here. Okay. Let's look into the next one here. Abacus Co. started the year with a total receivables of 87,000. Okay, so what did Abacus Co do? Abacus Co started the year with a receivables of 87,000. So how much was the total receivables? 87,000. Okay, how much was your total receivables? It was 87,000. Okay, how much was your total receivables? Okay, how much was your total receivables? Okay, how much was your total receivables? 87,000. Okay, and allowance for receivables were 2,500. Okay, so your net receivables would be 84,500. Okay, so 80. So your receivables were 87,000. Your opening receivables were 2,500. This was your opening receivables. Okay, opening receivables were 2,500. So your opening receivables, you can see opening receivables were 2,500. This was your opening receivables. Okay. Opening allowance, sorry. Opening allowance were 2,500. Okay, opening allowance. During the year, two debts were written off. So how much were total write-off? 800 was written off, 550 was written off. So total write-off was 1,350. Total write-off was 1,350. Okay, total written off. Total write-off was 1,350. What was the total write-off? 1,350. Okay, how much was your write-off? 1,350. Okay, how much was your total write-off? 1,350. Okay, 800 plus 550. Your total write-off was 1,350. Okay, total write-off 1,350. Okay. A debt of 350 had been written off as an irrecoverable in the previous year was paid during the year. So from your total write-off, you remove 350 because this was recovered. This was recovered. Okay, 350 was recovered this year. Previously you wrote it off. This year you recovered that money. Right, so it reduces your recoverable. Right, it reduces your irrecoverable. Sorry, it reduces your irrecoverable because it has been recovered. So 1350 was during the year. Okay, 1350 was during the year. So they are asking what goes in PNL. So only the change goes to PNL. In PNL, we only put the change. So that's why we are not taking the opening because they don't want the total. They just want the change. How much change it happened. So 800 was during the year, irrecoverable. And change in what? They want change in irrecoverable. So during the year, how much irrecoverable? 1350. During the year, how much change in recoverable? 1350. Okay, during the year, how much was the change in recoverable? 1350. Okay, during the year, how much was recoverable? 1350. Okay, during the year, how much was the change? 1350 was the change. Okay, how much was the change? 1350 was the change. Then how much was recovered from that? Out of 1350, how much was recovered? 350 was recovered. So that reduces your 1350. 350 reduces it. Next, reduction in allowance for receivables. How much was the reduction in your allowance? How much was the reduction in your allowance for receivables? How much was the reduction in allowance for receivables? How much was your reduction? Next, they're telling at the end of the year, your receivable balance went to 2,300. Start of the year, it was 2,500. End of the year, it went to 2,300. Your allowance has come down. This is another income only, it's positive. So it again is a negative for your irrecoverable. They want the value for irrecoverable. So anything that is recovered, anything that is an expense is reduced, that is a negative number in the irrecoverable. Irrecoverable is what you will not get. So 1,350 you will not get, but in that two amounts are positive. Right. 350 additionally is positive because you've recovered it. 200 is more positive again because you have it's a reduction in your allowance. Right? It's a reduction in your allowance. We had done this some yesterday in T account format. Irrecoverable. So see the irrecoverable debts, the return of right of the irrecoverable debts here 800 plus 350. Okay. Then increase in allowance would be same side. But here there has been a decrease in allowance, so it's going opposite side. Recovery of irrecoverable debts, again opposite side. It's the same sum here. We had done this 234. It's the same repeated in 239, only that new items have come. Right? Instead of an increase in allowance, we have a decrease in allowance. So it comes here. We also have a recovery over here. And they just want to know how much has changed during the year. That's all. They don't want the final amount that goes to the balance sheet. That's why we have not made this T account. They don't want to know the final. They just want how much change during the year. 800 bucks change during the year. $800 change during the year. They just want to know how much change during the year. 800 change during the year. Okay. Let's make sense of this one here. Yeah. Jaswanti, how did we understand this one? Yeah. Jaswanti, can you hear me? Okay. Okay. Let's take this one here. Ranbir, how have you understood this one, buddy?
So can you hear me?
Yeah, I can now. Yeah.
So first off, we have 1,350 because 800 and 550 were written off,
Mm.
and 350 was recovered.
Mm.
So we subtract that, and the allowance for the receivables is reduced by 200. So we subtract that as well,
Mm.
and we get changes to statement to profit and loss.
Profit and loss. Perfect. Okay, so thanks, buddy. So whenever there's a change, that when they ask for a change, you don't need to make the T account. Most of the times, you can just make the T account when they ask for anything missing or when there's a balance sheet question, right? Oftentimes, when it's just P&L, you can just do it directly only. They just want to know how much it changed, so you didn't need the opening and the closing, right? If you add the opening and the closing, it would not be P&L. In P&L, we only put the change, right? Whenever we do P&L, we only put the change there. We don't put the total. We only put the change. We don't put the total. We only put the change. 239 done. Moving on now. 240. An increase in the allowance for receivables results in which of the following? An increase in the allowance for receivables results in which of the following? Okay, so what has happened over here? An increase in the allowance. So you have increased your allowance. We had seen previously when your allowance increases, what happens? Yeah. When your allowance increases, your profit is reduced. Right? We had just seen this. It's on the similar genre. That's why I'm just highlighting it. When your allowance has increased, your profit will reduce. Okay. When your allowance will increase, your profit is reduced. Okay. When your allowance is increased, your profit will reduce. Okay. When your allowance is increased, your profit is reduced. So first we look into an increase in allowance for receivable result in which of the following? First one, an increase in net assets. Okay. So how you look at it is that whenever there's an increase in your allowance, so what happens is your receivable decreases. So what is the formula for current net current assets? Assets minus liability. Okay. You see, an increase in sales, not at all. It has nothing to do with sales. A decrease in drawings, it has nothing to do with it. So these two are the completely out of bounds. Right? Receivables has nothing to do with this. Right? Sorry, your allowance has nothing to do with these. Okay. Now, but coming to an increase or a decrease in net assets. Now, how do you know what is net current assets? Net current assets is basically asset minus liability. Okay. Let me just make sense of this here. Net current assets is assets minus liability. Okay. So let's assume your asset was 500, your liability was 400. Okay. So your current assets was 500, your current assets were 500, your current liability was 400. Okay. So here you have a net current assets of 100. Okay. You have a net current assets of 100. Now what happened? Your receivable went down because of your allowance increasing. What happened? Your allowance increased, so your receivables came down. So now your Okay, now your receivables, current assets have become 450. Why? Because current assets has receivables. Receivables have decreased. Why did receivable decrease? Because allowance increased. So your receivables have decreased. So now your current assets only at 450. So if you see your current liability staying as it is, now you see your net current assets has come down to 50. Your net current assets has come down to 50. Your current assets were 500 and 450. Your current liability was 400 and 400. So your net current assets, if you see, has come down to 100 in the first case. Second case, your net current assets has come down to 50. Okay. Second case, your net current assets have come down to 50. So you see, overall, your net current assets have reduced, right? Because your allowance went up. Now, why did this 500 become 450? Why? Because A, your receivables went down. Why? Because your allowance went up. And that is why this reduction happened. Okay. Your allowance went up. Your receivables went down, your allowance went up. What happens? Your receivables went down and your allowance went up. Your receivables went down, your allowance went up, so your current assets has reduced. So only your current assets has reduced. So only your current assets has reduced. Okay, so only your current assets has reduced. Okay, so only your current assets has reduced. And if your current assets have reduced here because of your receivables going up or down and your allowance going up, your net current assets has fallen. And that is the answer. Your net decrease in your net current assets. So what is net current assets? Assets minus current liability will give you net current assets. Current assets minus current liability will give you net current assets. No, current assets minus current liability will give you a net current assets. And when your allowance goes up, okay, will give you net current assets. And when your allowance goes up, okay, and when your allowance goes up, okay, and when your allowance goes up, what happens is when your allowance goes up, what happens is when your allowance goes up, what is happening in that situation? If your allowance has gone up, what is happening in that situation is that your receivables are decreasing. When your receivables are decreasing, what is happening? Your current assets are decreasing. When current assets are decreasing, what is happening is that your net current assets is falling because of an increase in allowance. Okay, allowance affect receivables, receivable affects current assets minus current liability gets affected. As a result, your net current assets falls. Okay, that is about 240. Okay, let's make sense of this one here. Jaswanti, can you hear me now?
Yes, sir.
Yeah, let's make sense of 240. How have you understood this one?
So the receivables have decreased.
Hmm.
The allowance for receivables have increased.
Hmm.
So there's a decrease in the non-current assets.
A decrease in the current assets. Okay.
Sorry, the net current asset.
Okay, yeah, perfect. So the decrease in your current asset, hence overall there's a decrease in your net current assets. Perfect. So that is all about 240. Moving on now, 241. Okay, similar thing guys here again. It's a similar question. Let's make sense of this one. What about this one here? So let's solve this 241. At the end of 2007, Charu's receivables balance was 230,000. Okay, what was it? The receivable balance was 230,000. Okay, Charu's receivables balance was 230,000. Okay, so Charu has customers who own 230,000. Okay, so Charu has customers who own 230,000, who owe her 230,000. So the brought forward of receivables is 230,000. Okay, and the allowance is 11,700. So she's already kept us out 11,700 as maybe they won't pay. That is an allowance. Maybe they won't pay money. So she has kept in the side. Maybe they won't pay money. How much have they kept aside? Maybe they won't pay money they have kept aside. Okay, 11,700 they have kept aside. Maybe they won't pay. Okay, how much have they kept aside? They have kept aside 11,700. That is, maybe they won't pay money they have kept aside. Okay, so we do 230,000 and we remove 11,700 from that. Maybe they won't pay money. Okay, so receivables was 230,000 and from that we have removed 11,700. Okay, from 230,000 we have removed 11,700. Okay, receivables were 230,000 and from that we have removed 11,700. Okay. Irrecoverable debts of 11,429 were written off. So during the year there was a reduction. The receivables of 11,429 were also written off. Okay. At the end of the year, Charu wishes to make an specific allowance only for Emily's debt of 450. He wants to make a specific allowance of only Emily's debt of 450. Okay. So firstly, now two things happen is she confirms that 11,429 will never be paid. So she has written it off. Second, she only wants to keep an allowance for two risky customers. Okay, she only wants to keep an allowance for two risky customers. Emily's 450 and Lulu's 980. Okay, only for two customers she wants to keep a she wants to wishes to make a only for these two people she wants to make a specific allowance. Okay, she only wants to make a specific allowance. Okay, so what is the movement in her allowance? So can we say her allowance is reduced by 10,270, right? Because she only wants to keep a allowance for only two customers. So before her allowance was 11,700. Now she only wants to keep an allowance for these two customers. Everything else she wants to remove. Okay. Everything else she wants to remove. This is all she wants to keep for a customer. Only two allowance, only 10,000 for two customers, 450, 980. She wants to keep everything she else wants to remove. Okay, this is what she wants to do. So if you see how much has been a reduction in your receivables overall, your allowance has been reduced. Okay, so she wants to just keep, so there has been a reduction in your allowance. Okay, there has been a reduction in your allowance. So she's just keeping some, remaining she's letting go. She's keeping some and she's remaining the letting go the remaining. Okay. So now you see your receivables has come down to 218,571. Yeah, 218. Now this will go into your balance sheet. This is your receivables at the end of the year. You see the allowance. The allowance is 1430. Okay, so 1430. This is the only allowance he wants to keep. Nothing else. He doesn't want to keep anything else. Now they're asking what is the net change in P&L. What they're asking, what is the net change in profit and loss? So only the movement you have to tell in irrecoverable, in respect of irrecoverable debts and allowance. So what is the net change? Okay. So in case of P&L, how much is the net change? So first of all, write-off is there. One write-off is there, 11,429. Okay. One write-off is there, 11,429. Okay. That is the one write-off. Okay. One is the write-off, 11,429. Second thing is the change in your allowance. Okay. How much is the change in your allowance? There's a change in allowance also, 1159. Okay. So there's a allowance has changed. By how much has your allowance changed? Right. Your allowance has also changed. Right. There's a movement in your allowance also. Allowance has changed by 10,270. So 11,429 you have written off. Allowance is 10,270. So total change has been how much? Just net the two ones here, Bhavya. 11,429 और 10,270 को माइनस कर दो. टोटल चेंज कितना आ गया? हाँ, वह दो चीज आपने करी. एक तो आपने you have written off something. This is so definitely going in P&L. One is your write-off. Second, you have reduced your allowance. So basically your expense have reduced. So you decrease it from the expense. So 10,270 आप minus करो. Not this 999. Just reduce the 10,270 from that because this is the total change in your allowance. So net how much is the change in P&L? Okay, so this is your change. There's no need to get this 999 out of nowhere. Okay, this is an extra number. Don't need to get this anywhere. Two changes have happened. First change is what? You have made a written off, write off. How much have you made write off? 11,249 you have made a write off over here. Okay, only two numbers are of importance here. How much have you written off? 429. And how much have you reduced your allowance? 10,270. Right? So one is a positive, one is negative. So what is the net change? One is positive, one is negative. We just focus on the net change. Okay, one is positive, one is negative. Just focus on the net change. One is a positive number, one is a negative number. What you have to focus is on the net change. How much has been the net change? Okay, all we have to focus right now is how much is your net change. Okay, we have to just focus on the net change right now, not too much. Just focus on the net change. Okay, our focus has to be currently on the net change. That's it. Okay, your focus has to be currently just on the net change. Just on the net change, we need to have the focus. Nothing else. Just we have to have the focus on the net change. Okay, 11,429 and the net change is 1159. We have the net change. Okay, the focus is only has to be on the net change 1159. That is your net change. Okay, 11,429 is what you have written off. 10,270 is how much you are. 11,429 is what you have written off. 10,270 is your reduction in your allowance. How much you have reduced in your allowance, and the net change is 1159. That's it. Just these two, you net it off and you will get your result of 1159. Okay, so this is the total change that has happened. A, with regards to irrecoverable debts, that is 11,429, and second, with regards to allowance for receivables. Right, one is with regards to irrecoverable debts. Okay, first one is with regards to irrecoverable debts, 11,429. Yeah, one is with regards to irrecoverable debts, 11,429. This is with regards to irrecoverable debts. Okay, one is with regards to irrecoverable debts. Okay, the other one is with regards to your change in your allowance, 10,270. You net these two and you'll get your answer. Okay, we'll look into the next one here. Which of the following is not a benefit of providing credit to customers? So see, basically, when you provide credit to customers, what happens? Okay, when you provide to customer credit to customer, obviously, you have more sales, customers are more loyal, and you'll get new customers also. But your cash flow never improves, right? Your cash flow never improves. Just because if you give credit doesn't mean your cash flow will improve, right? Giving credit does not improve your cash flow. Okay, giving credit does not improve your cash flow. Just because you're giving credit doesn't mean your cash flow will improve, right? Giving credit doesn't improve your cash flow. Okay, giving credit, it will not improve your cash flow. Okay, your cash flow doesn't get improved. If you give credit, that doesn't mean your cash flow will be improved. That it doesn't improve your cash flow. No, nowhere. It may improve, not at all. If anything, you're gonna get lesser money now because you're giving more credit. Okay. Next, we're looking into age receivable. Now, what is age receivables? You basically see what is age receivables. In age receivables, you basically see 30 days overdue. How many people have not paid? Or overdue by 30 days have not paid. How many people are overdue by 60 days and not paid? How many people are overdue by 100 days and they have not paid? Right? How many people are overdue and they have not paid? Okay. How many people are overdue and they have not paid? Okay. That's what we're looking into. How many people are overdue and they have not paid? Okay. How many people are overdue and they have not paid? Okay. So what is the main purpose of an age receivables analysis? Okay. Firstly, to ensure credit is not extended to unapproved customers. Not really. This is credit worthiness. You check the credit worthiness. So A is not about the purpose of age receivables analysis. B, to ensure that the credit customers regularly purchase goods from the business. To ensure that credit customers regularly purchase. For that, you don't do the analysis. For that, you give the credit, right? You give credit, right? For that, all you do is you just give credit, right? To ensure credit customers regularly purchase the goods. Said no one. All you do is you just give credit. In this situation, the only thing that you do is you give the credit. That's all. Next, to keep a track. Yes, this is what it really helps in, right? You can keep a track of outstanding debts and you can also identify overdue amounts to follow up, right? You can keep a track of outstanding debts and also you can identify any overdue amounts to follow up. Yes, this is right. You keep a track of any outstanding debts and you identify any overdue amounts to follow up. Absolutely. Okay, this is what you do. This is why you do age receivables analysis. You keep a track of outstanding debts and you identify any overdue amounts to follow up. Okay, you keep a track of outstanding debts and you identify any overdue amounts to follow up. Absolutely. Okay, you keep a track and you keep identify any overdue amounts to follow up. You keep an overdue amount to follow up. Next, you look into 244. What about this here? Okay. On 31st March, the balance on the receivables of Pico was 425,700. Now, okay, on 31st March, the balance was 425,700. This was the balance on 31st March. Okay, on 31st March, this was the balance. Okay, on 31st March, this was the balance of Pico. What was the balance of Pico? 425,700. Okay, on 31st March, this was the balance on the receivables of Pico, 425,700. This was the balance on the receivables of Pico. This was the balance, 425,700. Okay, on 31st March, the balance on the receivables of Pico was 425,700. This was the balance. Okay, okay, got that. Opening balance. So your opening receivables were 425,700. This was your opening receivables. Okay. The following adjustments are needed. All right. Irrecoverable debt that is recovered. Right. Irrecoverable debts that is recovered. Okay. So what are you eventually finding? What was the expense for irrecoverable debt? So in irrecoverable debt, this is an opposite entry basically. Right. In irrecoverable debt, this is an opposite entry. You remove it from irrecoverable debts. Specific allowance required. Okay. Is this? It was decided that the amounts totaling to 8466 should be written off as irrecoverable. Okay, so how much have you written off as irrecoverable? 846 is irrecoverable. Clearly, you will show this as irrecoverable. The allowance now was 1900. Okay, the allowance now was 1900. Okay, so how much was your allowance now? Okay, so after you remove the irrecoverable debts, you have this. Then you are doing another specific allowance that you want for a specific allowance. You want this special allowance. So another 2400 goes there. Okay, so two things have gone there. One is your specific allowance, right? Special allowance you want to make. So that is extra you're making. Then you have your irrecoverable debts that you have written off this year. That goes to P&L. Okay, this goes to P&L, and including of both, then you have your irrecoverable debt recovered. Right, this is a negative entry. Why? Because you have recovered the money. It reduces your irrecoverable debt amount. Right, it reduces your irrecoverable debt basically. Right, so you subtract the 2000 that you have recovered, and you've got 8866. Okay, and you've got 8866. So firstly, you have your irrecoverable debts balance on the receivables amount less irrecoverable debts. So 8466 is there. First of all, balance on receivables amount 425,700 less the irrecoverable debts. Irrecoverable debts is 8466. Okay, so this is clearly irrecoverable. This goes there. Then you have whatever is remaining on that, you have a specific allowance required. Okay, you have a specific allowance that you require. What is the specific allowance that you require? 2,400 is the special allowance that you require. So you remove 2,400 from that. So what is this? Is another allowance, and then an irrecoverable debt recovered. Then another irrecoverable debt that is recovered. 2,000 is another irrecoverable debt that is recovered. Okay, 2,000 is another irrecoverable debt that you recover. Okay. So this is a negative number because this is reducing your expense because you've received the money. So 8866. This is a sum we have just done some time ago here also. Firstly, we had a irrecoverable debts and a reduction in allowance. Right. In this case, we have special allowance, so we add that also because they're telling you will make a special allowance this time. Okay, it's all the similar sums, guys. As you do it back to back, you will start to see that it's all comes from the same pattern, just few changes here and there. Right? So that's why when you study these questions together, and since you're doing it back to back, you start to see the patterns. So from this question it was like that, this question it's like that. And then when you revise it, knowing that pattern difference, you will see, you will understand it so much better. Okay, you will understand it so much better. Okay, what you will do is you will understand things so much better. Okay, moving on now. The 425 700 less your irrecoverable debts 8466, which is your irrecoverable 8466, and you get the special allowance required. From that, you recovered your irrecoverable debt. What did you do? You recovered your irrecoverable debt. You recovered it. Okay, so these two were your expenses, and the 2000 that you recovered, that you subtract. That's it. Whatever you recovered, you just subtract that. Whatever you were able to recover, you just subtract that. That's it. Done. Okay. We know what is the purpose of customer credit limits. Next, we'll look into what is the purpose of customers credit limits. Okay. What is the purpose of customer credit limits? Now, if you have credit limits, what is the benefit? Okay. What is the benefit here? Firstly, okay, to enable the entity to make a decision regarding whether trade or early settlement discount should be given. Not really. Manage the risk of cash not being paid for goods sold. Okay. To manage the risk of loss of business arising from customer not being able to pay for goods sold. Yes. To manage the risk of loss to the business, right? To manage the risk of loss to the business, right? So you're basically, what you're doing is you're managing the risk of loss to the business arising from credit customers not being able to pay. Credit limit is basically the max you can owe us. So if a customer doesn't pay, we don't lose too much money. It controls your bad debt risk, right? So if you set a limit and if the customer doesn't pay, you can still live with that, right? If you set up a limit and the customers do not pay, right? You have given X amount of money and the customer is saying, no, I can't pay now. So you can still live with that, right? You can still live with that, no problem. Okay, if the customer says, I cannot pay, you can still live with that, no problem. Okay, so that is the purpose of customer credit. You can still live with it, no problem. Okay, what you can do is you can still live with it. Okay, what you can do is that you can still live with it. There's no problem. You can still live with it. Okay, if the customer doesn't pay, you can still live with it. That is about this. Moving on now. 246. Irrecoverable debt recorded in the accounting records. We had studied this. Irrecoverable debt recorded in the accounting records. How is a irrecoverable debt recorded? As you can see here, when a debt is recorded as irrecoverable, it is removed from the receivables. So your receivables will be removed. It will be removed from your receivables. Right? What happens is it will be removed from your receivables and written off as an expense. Right? What will happen is it is, therefore, the best accounting treatment is to record the credit entry in the ledger account in which the original debt was made, the irrecoverable debt expense account. So what you do is you're writing it off irrecoverable debt expense account, and what you're doing is debit the bank because you have recovered the money, right? You have recovered some money. So originally you had written it off at irrecoverable debt expense initially. Now you have received it, so that balance will be reduced and money has come in your bank account, right? If you recover some money, what is the journal entry? That's what they're asking. They're asking is if you recover the money, what is the journal entry? Right? If you recover some money that you originally thought you will not be able to recover, what is your journal entry? Right? Initially, you had written it down as irrecoverable debt expense. Initially, you had written it down as irrecoverable debt expense. Initially, what you have done, you have written it down as irrecoverable debt expense. Before you had written it like that, irrecoverable debt expense. Okay. Before what you have written it down as irrecoverable debt expense. Before. Okay. What have you written it as? You had written it as irrecoverable debt expense. Okay. This is how much you have written it off as irrecoverable debt expense. So now you are crediting that, you're oppositing that expense account you're crediting, so that expense is getting reduced and you're debiting the bank. And you're debiting the bank. Debit bank and credit irrecoverable debt expense account. Debit bank and credit irrecoverable debt expense account. Okay, what you're doing, you're debiting the bank and crediting irrecoverable debt expense account. Debit the bank and credit the irrecoverable debt expense account. Okay, that's it. Debit the bank and credit the irrecoverable debt expense account. Okay, moving on now. Following the mid-year review of its aged receivable listing, right? Following a mid-year review. Okay, so following the mid-year review. So what you are doing, you are following a mid-year review. Following the mid-year review of your aged receivables listing. So you have done a review of the listing. Plutoco identified that three irrecoverable debts totaling 630 should be written off. One of the debts for 150 was already included in the allowance for receivables. So you want to write off the debts, right? So you want to write off that three irrecoverable debts totaling 630 should be written off. So if you're writing it off, you are reducing your receivables. Definitely you're reducing your receivables, right? What you're doing, you're reducing your receivables and you're creating an expense, irrecoverable debts expense. You're writing off your receivables and you're creating an expense. Okay, you're writing off your receivables and you're creating an expense. What you're doing is you're writing off your receivables. So trade receivables account, you're writing it off and you're creating an expense. The trade receivables is credited and your expense is debited. Trade receivables is credited and your expense is debited. You're writing off the receivables account, so credit, and you're debiting the expense. Okay, you're writing off the receivables account, so credit trade receivables, and you're debiting the expense. Credit the trade receivables, debit the expense, irrecoverable debt expense that you're debiting. The crediting the receivables account, and you're debiting the expense. Yeah, crediting the receivables, debiting the expense. That's it. Next. At its accounting year end, 30th November, Venusco decided to write off irrecoverable debt of 425 and also to increase the allowance for receivables by 160. So, at its accounting year end, 30th November, what does Venusco decide? It decided to write off irrecoverable debts of 425. What did it decide? It decided to write off irrecoverable debts of 425. Okay, what it will do? It will write off irrecoverable debts. What it will do? It will write off irrecoverable debts of 425. And also what it will do? It will increase the allowance for receivables by 160. Right? At its accounting year end of 30th November, Venusco decided to write off irrecoverable debts. Okay, it wanted to write off the irrecoverable debt. Similar question, guys. It wanted to write off the irrecoverable debts. How much? 425. So you will write it off. Okay. Similar, right? You're writing off the irrecoverable debt. So you're crediting your asset 425. Okay. And also to increase the allowance. So when you're increasing the allowance, right, what you're doing is you're increasing your allowance and also increase the allowance for receivables by 160, right? You're increasing the allowance for receivables. So liability, you're increasing it by 160, right? And debit the irrecoverable debts account, right? Lettering, what will be the effect on general ledger? So see, first of all, you are writing it off. So trade receivables, you're reducing 425. Second, you're increasing your receivables, right? You're further increasing the allowance for receivables by 160. You're further increasing the allowance, right? So again, that's a liability allowance, increasing the allowance for your receivables, so 160. And you debit the irrecoverable debts account. Okay, you debit the irrecoverable debts account. So that's the logic, right? You have two separate entries which are combined over here. An allowance increased and a debt receivable written off. An allowance increased and a receivable written off. The return of receivables, debit the irrecoverable debts to credit the receivables. An increase in allowances, debit the irrecoverable debts and credit the allowance for receivables. Debit the irrecoverable debts and credit the allowance for receivables. Okay, one is an increase in allowance, one is a write-off. One is an increase in allowance, the other is a write-off. Okay, one is an increase in allowance, the other is a write-off. In one case, you're increasing the allowance, the other it is a write-off. Okay, in one case, you're increasing the allowance, in the other case, it's a write-off. One is an increase in allowance, the other is a write-off. Okay, next we're looking into 249. At an accounting year end of 31st October, Neptune decided to write off irrecoverable debts of 673. Write off irrecoverable debts. Right? What you're doing is you're writing off irrecoverable debts. Okay, so you're crediting off your irrecoverable debts. Right? 673 you're writing off and reduce the allowance. Opposite side here. Reducing the allowance by 1 or by default. Right? So this will be the same entry, guys. This is the same questions back to back. You see, it's the same questions back to back, two entries combined, same type of question. But just in one case, decrease the allowance, in one case, increase the allowance. In one case, increase the allowance, one case, just the same question, guys. If you see back to back, it's the same question. One increases your allowance, one decreases your allowance. Okay, last question here, just to close it. During the accounting year, Jupiter unexpectedly received a receipt of 382 in relation to debt which had already been written off. So had already written it off before. Right? It was already an expense. Now you are reducing that expense and that money came to your bank. We just did this question. Right? We just did this question here. Recovered. I highlighted the word recovered. Same thing over here. Debit bank, credit the irrecoverable debts expense account. 246 and 250. It's the same question, just the words have changed. 246 and 250. Same question, just words have changed. Okay, literally the same question, just the words have changed. That's all. Okay, similar question, just the words have changed. Okay, and that's an end to chapter 3.